Hey, how you guys doing? Welcome to video number 3 of 3. So this will finish out our series. And what started this series was an ad saying, how can you make $500,000? And we started learning in the first video, which this is kind of the format that I use, that we basically finance everything that we buy, whether it be groceries or things that we're writing a check for. We give up interest out of that checking as soon as we pay for those things, or we use other people's money, say credit card, or we're borrowing money from a bank or whatever, and we give our interest away in that way. So how can we begin to save? And we learned that an average American is going to give away about $500,000 during the course of their lifetime. And so in video 1, I showed how we can begin to recapture or keep the $500,000 in our own family system, okay? And we learned that we basically deposit money into a banking mechanism. A lot of times we'll take our paycheck and we'll put most of it into the bank. We might save some of it. We're setting aside some for retirement, those kind of things. And in the meantime, we're buying cars, and we have remodeled debt and mortgages and student loan debt and all this other kind of debt. And we're paying varied amounts of interest on all of those. And yet we're told by the traditional financial planners to keep setting aside money into a mechanism where someday, way down the road, hopefully you'll have a big pool of money. And we teach, those of us that do infinite banking and teach infinite banking, we teach, let's replace that model and replace the bank with our own name. Okay, and we begin to take the money that we would typically put into a retirement system, and we put it into our own mechanism where we begin borrowing from ourselves to pay these debts, and begin paying ourselves back the 5%, 10%, 12%, and all these different percentages. We start the money funneling back to us. Okay, in the second video we added to that, and we began to show that the average American household is broken down into different things, such as vehicles or cars. We have housing, which makes up a big part of our expenses, and we have living expenses, which is probably the biggest, things like utilities, groceries, maybe student loan debt, or various other debts. And we see that 5% of our vehicle expenses are interest, 25% of our housing is interest, and 5% of our living expenses. And these are close to being correct, so that a total for an average American household, 35% of our dollars go to interest payments. And if you start thinking about that over the course of, an 80 or 90-year-old person, the course of their lifetime, what they've given away in interest, it's a massive amount of money. So I want to teach you exactly how to, let's look and see what we can do with our savings. Let's try to get to that 10%, and let's put it into a mechanism where we can begin using this to recapture the 35% that we typically give away. If we do that, and we learn how to do that, the amount of money going into our savings for future retirement is going to be astronomical. Not only is it going to include the money that we're putting in there, but what we are saving ourselves in the interest that we normally give away. Okay? So in the third video here, I want to take it to the final level. And that is on this particular chart. I'm going to show you exactly how to do the banking function in your own life, okay? Remember, we have a savings mechanism in a healthy scenario for a working American, okay? And again, this would be in Canada. This could work in other places of the world too, although I don't know about their their insurance part of that mechanism. Okay, we'd have to check on that. But assuming that you're in the US or Canada, we're going to decide to do our savings in a different way. And this mechanism here, where we're going to save our resources, is a mutual whole life insurance policy done with a very specific setup on that policy to produce the highest cash value and actually the lowest death benefit, because we're not talking about death protection, we're talking about banking and the financing function of your life. Okay, so the holding mechanism is that. And why do we do that? Is because this $10,000 in this scenario, the person is going to put in $10,000 a year towards their premium on a mutual whole life insurance policy. Out of that, there's different growing amounts of cash value available to them for the rest of their lives, and we're going to use that to recapture the interest that we typically give away. And the reason we do that is if you make a deposit into your premium, your policy, as soon as you make that deposit, you're guaranteed growth on that premium amount for the rest of your life. And some people would say, wait a minute, what if they take